Want to see how I calculate return on investment before I buy real estate? I'll show you how and more on this video. Are you ready? Let's go! Hi, thanks for tuning in. My name is Dean Ueda and I am a real estate investor and realtor in Honolulu, Hawaii. As a realtor, I get to work with investors, some experienced, others just starting out. The experienced investors often have their tried and true ways to determine if a potential property makes fiscal sense for them. Some of my clients, both experienced and new, rely on me for help in this area. What I wanted to cover on this video is the process I go through with them, which is also the exact same process when I'm looking for potential investments for myself. Hey, and if you're enjoying the content, please click subscribe, click on the bell, and especially click the like. Something about a YouTube algorithm? To determine if a property fits my investors or my financial goals, I run various calculations, but the most important to me is the cash-on-cash return on investment. Remember, cash flow is just one of the many benefits of real estate investing. Check out my video on all the other benefits of REI. I'll leave a link in the comments below. Per Investopedia, the cash-on-cash return is the cash income earned on the cash invested in the property. It's not rocket science, but it can be an art form. I just say that to make it sound hard, but it's really not. What I do is I take the annual gross rent, minus out operating expenses and mortgage payments if there is a loan, to come up with my annual cash flow. I then divide this number by the total initial cash invested. Initial cash invested includes the purchase price, unless it's financed, then it would be your down payment plus any fees and closing costs. Don't forget to include any repairs and improvement costs needed to get the place rent ready. So for the purposes of the operating expenses, I include property taxes, insurance, utilities, association and maintenance fees, and property management fees. Don't forget to include things such as landscaping, trash pickup, and snow plowing if you're lucky to live in a place with snow. I also include a reserve for the vacancy and repairs and maintenance. So many of these expense types can be forecasted easily. You can call an insurance agent and get a free quote. You can find out property taxes, that's public information. Property management fees are determined when you go shopping for the management company. The vacancy rate could be challenging, but for lack of a better number, have your property manager help you with this one. In the area that you are looking to purchase, find out how long tenants typically stay before vacating, and find out how long it typically takes for the property manager to fill those vacancies. Make sure to see if there are additional costs like lease-up fees or admin charges for vendor repair projects, as these additional costs could reduce your ROI. The main variable, in my opinion, that can make or break your cash-on-cash return on investment is the rent rate that you're using to calculate the annual gross rents on. You want to get this number pretty accurate because if you're off by a few $100s, you could drastically affect your return on investment. There are many ways to figure out this rent rate. Assuming your property manager is experienced and it knows the rental market in the area, you can always use them. There are a lot of online resources to corroborate or fine-tune the number your property manager gives you. This also depends on what online resources the self-managed landlords use in your neck of the woods. You can try Facebook Marketplace, Trulia, Zillow, even Craigslist. One site I often like to use is rentalmeter.com. This site allows a few free inquiries, then you have to sign up and pay a monthly fee. If you need any reports, just email me. I can run them for you. I have an account. Once you get your cash-on-cash return on investment percentage, now what do we do? Well, for me, I'm already shooting for a certain percentage target depending on where I'm investing. If I hit the target, then maybe that's a place to consider putting an offer on. When you get comfortable with the calculation, you can also run scenarios or sensitivity tests by playing with the numbers like increasing or decreasing rent rates. See what happens if the association fees go up 7% in a year. Then you can see how much of a hit you can take or get a better idea if income or expense changes. This may also help give you comfort or just the opposite in case your estimates are inaccurate. So that's how I calculate cash-on-cash return on investment for my clients and myself. I hope it helped. If you want to download the Excel template I use, see the link below in the comments and I'll send it to you. Thanks for watching, and in the words of the late business leader Peter Drucker, entrepreneurs believe that profit is what matters most in a new enterprise, but profit is secondary. Cash flow matters the most. I'll see you next week.